Robschild, no investment advice. Welcome to the show where we view financial markets using Ben Graham's investment philosophy, macro, technicals, and crystal ball gazing in that order. Today is Thursday, November 21st, 2024. Today's episode, we're going to start out by bringing up the initial jobless claims coming out, the actual number coming out, that's what the A is for, coming out at 213,000. This is below both the expected number of 220,000 and last month's reading of this at 217,000. I had considered the possibility of this suddenly being the black swan event maybe this week. Eventually, I suspect jobless claims will shoot up higher, but not this week. The leading economic indicator index came out today at negative 0.03%. Taking a look at tradingeconomics.com, they have a very nice chart of this, the U.S. leading index. Whenever the number is negative, it just simply means that it's going down that amount. And when this is going down, it's typically not very good news. Every time in the past that it's gone down, it's been coinciding with a recession. And ever since 1960, in 1969, for example, we had a recession, 1969 to 1970. We had 73 through 75 being a recession there, driven by the oil embargo, high inflation. And then 1980 through 1982, this was going down, 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 down. This was a recession involving the Gulf War, involving tight monetary policy. It was just part of the business cycle where, we flush out bad credit and, this was a recession right here. Again, in 1990 to 1991, we had the recession from high oil prices involving the Gulf War and restrictive monetary policy. And then, of course, the more recent, more familiar to pretty much everyone that's watching the dot-com bust from 2000 into 2001, 2002. Again, you can see it dropping there. And then, of course, the great financial crisis where this dropped a large amount. And then we had the COVID crash right there. And then ever since February of 2022, this has been going down without an official recession. The whole point of having a leading index is to show where the economy is going. And if it's going down, I should probably add this to my daily reminders. But, not a good sign. Again, this number is calculated using a whole bunch of items together, including the average weekly hours in manufacturing, average weekly initial claims for unemployment insurance, manufacturer new orders for consumer goods, new orders, excluding aircraft orders, building permits for new private housing, the S&P 500, stock prices. Imagine if the stock market starts going down, what this chart's going to look like. It already looks really bad. You could, when we were looking at the chart, imagine when we add stock prices going down into this leading credit index, interest rate spread. So being between the 10-year and the Fed funds rate, and average consumer expectations for business conditions, probably from the University of Michigan survey that they do. So the report came out and we're still going down. If we are indeed in a soft landing scenario, this can't just keep going down. And certainly if it accelerates to the downside, that would be even worse. The website also features a little button you can press down here that says CHG percentage. This is just showing the percentage that it's moving with every report. And so if this is going down and down and down, that means we're accelerating to the downside. Instead, we're still going down, but we're kind of going flat here. If anything, if we were to use this as a chart pattern like we use in stocks and those kinds of things, we're coiling up tightly here. Again, the most recent reading isn't actually here. The most recent reading would be for October at negative 0.3%. So the same level as here. So just wavering around back and forth here. And anything under zero means, it's going down. So if this means anything, it adds to the daily reminders and the crystal ball reading that we're headed into some pretty serious slowdowns. Last agenda item for today, Friday, we have PMIs coming out, perhaps affecting markets. Overall today, stocks went up, basically. I think maybe that was largely on the fact that the leading index wasn't showing more weakness than perhaps the market may have been sniffing out a little bit. And then initial jobless claims coming in at lower than they expected, and the last reading of this little weekly data point, obviously, I think helped give a little bit of confidence in markets. Nothing has changed in the daily reminders. If you want to hear me walk through things that I think are very important to be thinking about on a daily basis, watch Monday's show. That's November 18th show, the one that has a yellow castle in the ball. With none of the daily reminders changing at all today, the crystal ball ratings remain that the S&P 500 is currently priced like it's a Ponzi scheme, relying only on other people to bid the price higher without the corresponding value to back it up, and that there is a bear market imminent, and that the Fed won't cut fast enough to save the economy, even if they try, which they'll have trouble trying because inflation's high. But you won't watch Monday's show to see the full viewpoint. We'll begin with the SPX, the S&P 500 today, having quite a battle. When you have a little tiny candle like this, it sort of suggests a fight going on between bears and bulls. From a charting perspective, I'm not sure if we're going to be headed back up to this line here or if we're headed down. But based on my macro views, I will favor the probability to the downside, though I'm not shorting the S&P 500 directly at this point. I am shorting, however, SMH, the semiconductor industry. Although yesterday, because of Nvidia coming out with their earnings, you never know what Mr. Market here is going to do. As much as one can understand where we are in the business cycle and how valuations work, I can't control you and other people. If you're someone that's like buying this fund from another person, I have no control over what people are doing in the market. I can only guess what will likely happen based on what I know. And what I know is that the valuation of this industry, I believe, is highly, highly overvalued. And we have some great chart patterns that are setting up a bearish move here. Although we broke today above this little head and shoulders pattern today, closing here, it's not a very strong candle with these very big wicks. If it was strong, we would want to open at the bottom and close at the top. It also suggests, what institutions are doing here. If institutions really wanted to buy at this level, you would see it open lower, and you'd see it going up and up and up through the day. You'd see a solid green candle. You wouldn't see this little candle here. It looks like maybe we're going to test this breakout. It would make sense to test this breakout of this ascending wedge pattern before heading down to the neckline of this giant, beautiful head and shoulders pattern, again with ginormous solid engulfing candles on both shoulders and a double one on the head. Beautiful setup. And I am jumping the gun on this, on the head and shoulders part of it. Just because you see a head and shoulders developing, it doesn't give it any weight for it to play out. This ascending wedge is the one that can really drive it perhaps down, and this engulfing candle are the ones that can drive it down to the neckline. For the head to the neckline to play out to the downside, we would need to crack below the purple line and confirm it, and that would give a lot more weight to the semiconductor industry to head much lower. The way I'm playing it is as it drops, I'm sort of trimming the position to maintain a 5% portfolio allocation to shorting SMH with SOXS. I've been bringing this chart up a lot recently because I think it's getting very suspicious looking and looking like it's ready to break one way or the other. This is the 10-year break-even inflation rate. This is how markets are pricing inflation over the next 10 years based on Treasury inflation-protected securities and the regular 10-year Treasury note. This is the best indicator as to what, institutional, international money is betting on the inflation rate to be over the next 10 years. Of course, this can change dramatically over time. This is, not something that will just stay the same for a super long time. Notably, though, since 2020 with the COVID crash, this market was pricing in 0.5% inflation rate for the next 10 years briefly before they turned on the money printers and got everything going, and then we gradually had expectations rise, even when inflation, by the way, was all the way around like 6 or to 9%, something like that at the peak. This was only still suggesting pricing in a inflation rate of 3% over the next 10 years, and currently again we're at 2.34%, and just going so sideways here. I'm very curious to see if we're going to break higher or break lower. My guess, based on my macro views, is that this is going to be breaking down soon. Sorry if you're getting tired of some of the repetition. I try to limit repetition as much as possible. I mean, this is a daily show, but at least I'm not reading through all of the daily reminders every day anymore. The 10-year Treasury note yield, again, this purple line, the top of 21, giant head and shoulders top, breaking to the downside and basically testing this purple line right now. Like the past week, we're just sitting at this line trying to see if we're going to break out to the upside or to the downside. I've been talking about it looking like that we're going to peak out here in yields. It would make sense for 1,001 reasons for yields to roll over to the downside, in my opinion. Obviously, that's how I feel when I have 55% of my portfolio exposed to leveraged versions of TLT, basically, long duration Treasury securities. So the battle is still happening. Like I thought, I thought especially yesterday once we cracked below this purple line, which can be, adjustable to some degree depending on, these candlesticks. Do you use the bottom of the wick? Do you use the, closing only candles? And then not only that, like having a chart going back to several years. It might be better to be using weekly candles instead of daily candles for a pattern like this. But yeah, any way you look at it, we're still fighting the battle here, and I'm excited to see if the bears or bulls will win on Treasury yields here. I mean, it's really hard for me to imagine Treasury yields going up right now with the Fed starting their cutting cycle, with the overvaluation of U.S. stocks in the first place, and I mean, one of the sort of beautiful parts of this is that high yields, they cause lower yields because it's higher yields, even on the longer end of the curve, are, they're basically putting pressure on companies, because companies, when they roll over their debt, they have to pay this yield plus their credit spread on top of it. And so it slows down earnings even further. Earnings are already, way below where they need to be for the valuations of stocks to make sense right now. And so it makes perfect sense for yields to drop here. But again, like Mr. Market can do anything. Well, it's exciting times in markets, anyway you look at it. Another chart I've been bringing up a lot lately, DXY, the dollar index. I said this looks like a bull flag. We popped to the upside and I said it looks bullish, and it went up to a new recent high. This is another thing that causes pressure on, the world economies. A lot of the world, the euro dollar system has dollar denominated debt, and when the dollar gets stronger, it's harder to pay that debt. Putting a lot of pressure on the global economy. Dollar is looking bullish. This could be the black swan. This could actually be the black swan that sets the recession off, and the sell off in equities and everything. If we continue ripping higher, I mean, where will this end? While everyone else is watching Bitcoin get to 100,000, I mean, there's an argument between the dollar and Bitcoin right now, right? They're both ripping higher at the same time. One of them's going to come out on top, in the short term. I have my suspicions it'll be the dollar. Like I always say on the show, nobody really wants Bitcoin at the end of the day. When they look at their Bitcoin, they're looking at it in price of dollars. You think someone cares about seeing, oh, I have 3 Bitcoin? That's meaningless without the value in dollars. People just want more dollars, and that's all there is to it. And like I always say, if you're buying Bitcoin, holding Bitcoin, hope you can find someone to buy it for even a higher price than it was today. I really wish you I wish you the best of luck. The dollar is ripping higher here. This is a big warning sign, everybody, especially for highly speculative assets such as Bitcoin. Crude oil, WTI crude oil. Look at this, guys, hitting this exact trend line, the peak in October 7th, 2024 to the peak of November 7th. We kissed it today. This is a little triangle here. I'm wondering what's going to happen. I mean, it's possible, I guess, this is officially a descending wedge. If it breaks out to the upside, maybe we could see oil go higher for a little bit here. But when zooming out on oil, again, I've been showing this a lot because of our proximity to this line here. Ever since 2021, we've been bumping on this line, and more recently hitting it 1, 2, 3, 4 times very recently. And if this breaks down, this could also be the black swan event. I mean, it's like all these black swans, you can literally see them coming very soon. I feel like I'm the only one seeing them come at this point. Everyone's excited about the seasonality of the end of the year, the Santa Claus rally. The fact that, I mean, it is true, seasonality wise, it's like this week, I think, is typically like the lowest week, and then we often get move higher throughout the rest of the year. I don't know if it'll happen or not. I have a feeling maybe it won't. I think, I've been prepared for markets to really sell off big time for quite a while now. And I'm seeing just so many indicators now, more just like, it's almost like exponential more indicators showing me I can literally see the black swans coming. If you think the Japanese yen carry trade blow up was bad, I think there's much bigger blow ups coming. But that's just me and my crystal ball. Next, silver. I hate drawing charts on silver because I swear every time I find a pattern, it just totally goes the other way, even if it breaks the neckline and retests it of Head and Shoulders. It's like one of these markets that I swear somebody is just purposefully trying to get people on the wrong side of it all the time. Anyway, the chart today just caught my eye because I found a line that looks like we could be at Head and Shoulders here forming. I mean, yeah, that's what it looks like. With all these other markets showing we're having very bearish setups, again, is this another black swan? Is silver about to crash? We'll see. K-Web, the Chinese ETF holding Alibaba, JD, Baidu, so on and so on, basically Facebook, Amazon, all these internet companies, but of China, I had talked about how we had basically broken down out of this bear flag, and I was expecting this pattern to sort of play out to the downside. Interestingly, we haven't fully played out this pattern of this bear flag. We're really pausing here. So my question now is, what's next? Sorry, my charts are going a little nuts here. So yeah, we're coiling up here. I don't know what this is. Maybe it's bottom, I'm not sure. What I do know about China from listening to other people talk about it, apparently China is saying they're going to announce more of their stimulus packages or ideas to help China get out of their recession or depression or whatever they're in, and it will be announced in December. So maybe the market's kind of preparing for, some bigger stimulative moods to get the Chinese equities and their economy out of their glut. I've been bringing up wood on the show a good amount. Look, I'm not, as much as I use charts to help guide my crystal ball reading, I'm more of a Ben Graham guy than I'm over everything else. Value investing, that's number one, like I always say. And then secondary is my macro views. And if the charts in the crystal ball reading, start to match up with those things, they just give me further confidence in my views and my investing choices. So what I'm trying to say is I'm not the greatest chart drawer or reader here, but I can see things that are obvious. Point is, I have been using the bottom of the wick as the neckline for this Head and Shoulders top on wood, saying how we broke through it to the upside. And, if we use a closing and opening basis only, we're actually just fighting a battle here, basically hitting it today. So, yeah, from that perspective, and just look at this pattern. It's like a child just sat down and was told, okay, draw a Head and Shoulders pattern. And he just took the crayon and just, like, it's perfect. There's hardly any deviation from the pattern at all. Amazing. And then just going down and then just going straight back up to the line and fighting here. So another chart with a crystal ball and all, suggesting that things might be falling apart here very soon. But for now, speculators in the markets, the most speculative of all, the Bitcoin buyers at $98,000 for a Bitcoin. What if, looking in my crystal ball, what if 100,000, being a very psychological level, is it? We hit the 100,000, and who knows? Maybe Bitcoin falling off of a cliff could end up being the black swan event that sends things flying to the downside. I don't feel like I'm hearing a lot of anyone else see all of these things put together and see so much scariness as I see them right now with my crystal ball and all. But I feel like I can see the black swans coming, like now, like tomorrow, like next week, we're here. But that's just me and my crystal ball, and that's all from me and my crystal ball. Hope you enjoyed. Thank you for watching, and see you next time. Rob's Child.